Let's bring in Peter Schiff, Chief Economist and Global Strategist at Euro Pacific Capital. Always a pleasure to have you on, Peter. I want to start with this latest jobs data. Now, we hear about new jobless claims falling to pandemic-era lows while we're facing record job openings. What is this telling us about the state of the recovery and the job market?
Well, first of all, I don't think the economy has recovered from anything. I think it's still very sick and having nothing to do with COVID. I think all that happened is the government printed a bunch of money, or the Fed printed the money, and the government mailed out the checks, and everybody went on a spending binge. And so all of that temporarily boosted the GDP numbers, but it's also the reason that prices have gone way up. It's the inflation that the Federal Reserve has created. And, you know, these unemployment numbers, I mean, we're still getting a lot of claims. They're just not as high as they used to be. And a lot of people just don't want to work anymore. I mean, the government has made people a better deal. A lot of people find it's more lucrative to take a vacation than to show up for work.
Now, on Friday, we will see jobs data for the entire month of August, the last before the Fed's next policy meeting. And one of the points we have heard from Jay Powell over and over again is the need to get employment stable before they can pull back on the easy monetary policy. Now, we know you aren't a fan of the Fed's policy, but when we are seeing the best numbers in the pandemic era, is it time to start that taper? What say you?
Well, the Fed is just making up excuses because it knows the only foundation this bubble economy has is the Fed's easy money policies. And I don't think they have any actual plans to taper. And even if they just kind of feign the process by beginning it, they'll never complete it, because soon after they start the taper, again, if they even ever start, they're going to have to reverse the process, because ultimately the Fed is going to expand the QE program and start to buy a lot more government treasuries and mortgage-backed securities in the future than it's doing right now.
And Peter, you know, I know this is something we've talked about quite a bit on the show when we talk about the Fed's policy, and I don't think we've talked about it with you. But it seems also that the Fed has had this whole thing of course, they're saying they're propping up the economy. More importantly, they're saying when it comes to raising interest rates, when pulling back that QE, you know, it could cause a market crash, which is, you know, at or near record highs right now, all three major indices in the United States. But in reality, that's not their responsibility, correct?
Well, technically, no. But remember, these guys think that the economy lives or dies by the market. Remember, their whole goal in QE was to create a wealth effect. They thought if they could make the stock market go up, we'd all feel wealthier, and then somehow we'd spend more money. And so they're kind of wedded to this philosophy. So whenever the stock market starts to go down, they start to fear a reverse wealth effect. And so they start printing money. But it's not just the stock market that they're propping up. It's this whole bubble economy that they're filling up with air. But by doing this, they're actually undermining legitimate economic growth, and they're making everybody poor.
Well, and Peter, you know, you have to wonder, Don Cohen, the Fed's former vice chair of financial supervision, he warned of the possibility of another financial crisis during last week's Jackson Hole Symposium, pointing to vulnerabilities as asset values have hit record highs and government and private debt have reached near record highs. So how close are we, when we look at all of this, to that bubble bursting, as you say?
Well, if the Fed did the right thing, we would absolutely have a financial crisis. In fact, it would be worse than the one we had in 2008. That's why the Fed is not going to do the right thing. That's why they keep kicking the can down the road, because they want to delay that crisis as long as possible. But the longer they delay it, the worse it's going to be, because the only way to delay it is to make the bubble bigger. And the bigger the bubble is, the worse the fallout when it pops.
Yeah, you got to keep kicking that can down the road in hopes that somebody else, some other administration will have to deal with it eventually. Now, we can't have you on without, of course, talking about gold. And we know that inflation in Germany hit a 13-year high in August. And as it has been facing rising inflation, demand for physical gold in Germany increased to the highest level since at least 2009. What do you make of this? And are we seeing an increase in demand for gold elsewhere as an inflation hedge?
Well, absolutely. There's a lot more inflation to hedge, and people should be a lot more fearful about it now than they have been in the past. And, you know, the Germans are particularly sensitive to this issue, having, you know, lived through some of them Weimar Republic, but certainly it's fresh in their minds. In America, we think about the Great Depression. They think about the great hyperinflation over there in Germany. So if they start to whiff the scent of inflation, they're going to be quicker to react to it. But, you know, inflation is going to be a problem worldwide. Central banks around the world are printing too much money. They're keeping interest rates artificially low. And so inflation is a worldwide problem, but it's going to be particularly acute here in the United States. We're creating more inflation than most, and we are more dependent than any other country on the value of our currency to fund our imports because we can't produce the goods that we consume. And so we have to trade the money that we print for the stuff everybody else makes. And so as the value of our money is going down, we're going to really feel the pain of inflation to a much greater degree as the dollar falls and the cost of those imports go through the roof.
You know, and Peter, if you're right about all this, it's going to be a wonder if central banks will continue to do the same policy over and over and over again. Peter Schiff, Chief Economist and Global Strategist with Euro Pacific Capital. Always appreciate having you on.